What an incredible comeback. Virtual's protocol has more than doubled in the last week. The environment in general was positive, but the question is, why was Virtual outperforming that much more? Let's have a look at who's buying here, who's selling here. Let's have a look at the on-chain data. Let's try to figure out what's behind this rally and how much longer this rally can potentially last. Because there was a time where Virtual's protocol was close to 5 billion in market cap. Now we are at 1 billion. So is there the possibility for another 4 to 5x from here? We are currently at $1.60, and there is a slight difference between the market cap chart and the price chart. And that's because Virtual Protocol did raise quite a bit of money and the supply does inflate over time. What's fascinating is that AI does not give us an answer for this rally. There seems to be no major news. This is the CoinMarketCap AI, and apparently it's just a technical breakout. It's just the AI ecosystem as a whole and a market-wide rally. But as we've seen at the beginning of this video, Virtual is doing much better than the overall market. So something seems to be going on intrinsically for the protocol itself. Have a look at the market cap relative to the fully diluted valuation. So there's a gap. We peaked in terms of fee revenues at the beginning of the year. Now we are trading at a somewhat constant level. The liquidity in the Virtual token is fluctuating quite a bit though. Now we have to look at all sides of supply versus demand in order to figure out where the price might be going. One of the major drivers of supply and demand is staking. As in, when there's more tokens that get locked up, that get staked, then that supply gets reduced from the circulating supply, potentially pushing up the price. When the number of staked tokens is going down, that can potentially increase the circulating supply and depress the price. Now what we see over here is the number of staked virtual tokens over time. And there was quite a bit of excitement for the staking program, but unfortunately that turned around in the middle of June of this year. So in the last 4 months, we saw more virtual tokens getting unstaked, increasing the supply, which is not good for price development. It seems so that the trend is stabilizing, at least for the last 4 to 5 weeks. Now, I always like to look at opportunity costs, as in, does it make sense to buy Virtual Protocol, or does it make sense to buy Bitcoin or Ethereum or any other altcoin? Now, what's the best benchmark to compare Virtual with? I think it's Ethereum, because Virtual was launched on the Base chain, and Base is a layer 2 on top of Ethereum. It uses Ethereum as gas. And when we look at the decentralized exchange trading volume over time, most of that trading volume is still versus wrapped Ethereum. It is not versus Bitcoin, it is not versus USDC, it is versus wrapped Ethereum. So really, the virtual price is directly bound with the Ethereum price. When Ethereum goes down by 10%, Virtual goes down by 10%. When Ethereum goes up by 10%, Virtual tends to go up by 10% as well. There's simply a binding within the liquidity pools. And so let's have a look at the relative valuation of Virtual to Ethereum. That's this chart over here. Initially, there was a lot of adoption of Virtual's protocol. Again, we saw growth until the beginning of May of this year, but then came the rough sell-off. Virtual underperformed ETH by more than 80%, and now we are rallying again. The dotted line over here, by the way, that's the historical average ratio of Virtual versus Ethereum. So if we regard that as a potential equilibrium, we still might have another 25% outperformance versus ETH. So if history is any indication, we could of course still see a 4x in the price, but then we're going to overshoot the historical average ratio to Ethereum. Of course, to see those very high prices, we also need to see Ethereum going up, because this peak over here, it corresponds with this peak over here, and that is not a gain of 300%, but only a gain of 160%. So really, Ethereum needs to see major gains as well to bring us back above $4 in the Virtual token. Virtual's protocol is a launchpad for AI agents, including their tokens. So there's the Virtual token itself, and there are all the tokens that get launched through the Virtual's protocol platform. Now here's the trading volume of the tokens that got launched via the Virtual platform. Again, there was a lot of excitement at the beginning of the year, and now we are trading at a somewhat constant low level. Here are the number of daily active wallets. Most wallets just trade one token, and that's of course the Virtual token itself. And again, the platform is still active. It's just not as hyped as it used to be. Here's the number of active wallets per day. The biggest of the AI agent tokens is the game token. It's got a market share in terms of total value locked of 4.5 million. And here's the game price relative to the virtual price. It's slightly above its historical average. And even though it's the leader, it still has a hard time outperforming the virtual token itself. And it's rather at the upper end of the trading range. So probably the virtual token is currently a better bet compared to getting into an individual agent token. At least that's true for game. What we see over here, that's the TVL, or the total value locked, of all of the tokens that got launched via the virtual protocol. And that's a quite encouraging chart, because even though the trading volume is relatively low, the capital did not necessarily shrink over time. We had our peak in terms of trading volume at the beginning of the year, but the capital that's in the ecosystem did not really exit over the last 10 months. Now, we are mainly interested in the price development of the virtual token, not of the individual ecosystem token. So let's have a look at who's currently buying and selling. Let's have a look at the on-chain metrics. There are three versions of the token. There's a token on the base chain. This is where everything started. There's a token on Ethereum, and there's also now a token on Solana. On the base chain, we've got almost 1 million holders. On Ethereum, we've got 32,000 holders, and on Solana, we've got 26,000 holders. Now, what we see here on the left side, that's the number of wallets that have at least 650 virtual tokens. That's roughly $1,000 worth of the token. In the middle, it's 6,500 tokens, so $10,000 worth of the token. On the right, it's 65,000 tokens, so $100,000 worth of the token. We go at 10x with every single chart: 1,000, 10,000, 100,000. So we're looking at the small retail investor versus the larger whale investor. We see that none of those wallet cohorts long-term accumulate anymore. The whales started selling at the beginning of the year, which was the right move. Medium-sized retail also sold around the same time, and the small retail investor was a bit late to the party. They only sold starting from the beginning of May. Now, relatively speaking, the number of whales grew the fastest in the last 3 months. It went up by roughly 10%. The number of small retail investors grew much less, only by around 3%. This is the numbers for the base chain, by the way. Here are the same numbers for Ethereum. Again, no accumulation recently anymore. And here are the numbers on Solana. Short term, of course, it's not the on-chain data that's moving the price. It's the perpetual futures, or the levered bets on the price. In the last 24 hours, we only saw 116 million worth of trading volume on Binance on the spot market. Compare this with the perpetual futures. Here we had 629 million worth of trading volume. So really, it's the bets on the price that move the price, and then arbitrage bots tend to make balancing trades on those different chains. Now, here's why I think virtual has a chance to rally a bit further right now in the short term. And that's because the vast majority of perpetual futures traders currently bet on falling prices. So this is unusual. For most altcoins, we tend to see a positive funding rate. So the longs have to pay the shorts to bet on rising prices. But when then suddenly the shorts have to pay the longs to bet on falling prices, that means that there's a lot of interest and a lot of conviction by the market that virtual is going down. What then tends to happen is that the market makers manipulate the price. Because fundamentally, they can make money in two ways when they buy up the spot market. First of all, they can liquidate the shorts. They're making money because all of those shorts, they lose money when the price is going up. But secondly, they can also earn money via the funding fees. So the market makers are going long on the perpetual futures, and they're also buying up the spot market, hurting the short investor in two ways. It's a definition of a short squeeze, and it becomes more and more profitable to do that short squeeze because the open interest is going up recently. There's more and more people betting on falling prices of Virtual's protocol. So there's more and more incentive by the market makers to buy up the token. The trading volume is surprisingly high given that the price is so low. So the trading volume on the perpetual futures market relative to the price is at levels that shouldn't be considered normal. So fundamentally, what I think is going on here is a short squeeze. So there are enough people that bet on falling prices that the market makers buy up the token and squeeze out those short positions. It's very similar to what happened with GameStop, just the other way around. With GameStop, it was the big guys, it was the hedge funds that were betting on falling prices. And then the small retail investor via Reddit forums bought up the stock and squeezed out the hedge funds, creating losses for the hedge funds. Here with Virtuous Protocol, it's the exact opposite. Here with Virtuous Protocol, it's the regular Joe that's betting on falling prices and the big guys and market makers that are buying up the token, pushing it to new heights and squeezing out all of those pessimists. And so this can continue for a while as long as the funding rates stay negative. Once they stabilize at a normal price again, then we are likely going to see a deflation in the price again. But where this exactly will happen is hard to tell. But probably we are going to relive through a similar price development again in the future after the short squeeze has finished. What I find fascinating is that the development within the altcoin market seems to move contrary to what's happening in Bitcoin. So when Bitcoin tends to do better, then the altcoins are rather weak. When the altcoins tend to do better, then Bitcoin tends to be weak. What we're seeing over here, that's the others dominance. So how much of all of crypto is in the altcoins that are not in the top 10 in terms of market cap? So it's a percent range that tends to peak out at around 20%. It's currently at 7%. Now have a look at the following. Let's have a look at the peaks and the bottoms. Let's also see where there's a potential support. That's maybe here. And let's now compare this with the Bitcoin dominance. So how much of all of crypto is currently in Bitcoin? Whenever the others dominance is peaking, the Bitcoin dominance tends to be low. Whenever the others dominance is bottoming, the Bitcoin dominance tends to be high. Here's another such peak where the Bitcoin dominance is high and the others dominance is low. So there seems to be a direct inverse correlation. And since the beginning of 2022, the altcoins tend to underperform and Bitcoin tends to outperform. And Bitcoin tends to trade in a range. It tends to peak at a dominance of 73%. So once Bitcoin is 73% of all of crypto, the altcoins historically were very cheap. The problem for altcoins right now is that the others dominance still continues to go down and Bitcoin dominance still tends to go up. And while the others dominance didn't necessarily always bottom at the exact same level, it tended to be somewhere around 5 to 6%. And currently we are at 7% dominance. And again, Bitcoin dominance has way more room to go until the altcoins become historically cheap again. So really, it does make sense to be selective when purchasing alts. It's maybe not the best time to have a diversified altcoin portfolio because most of them are likely going to be worse medium-term performers. What we see over here is the others market cap. So how much capital is currently in the altcoins that are not in the top 10? We're not looking at the others dominance, but at the others market cap. And the altcoins do have a hard time getting above 500 billion market cap in aggregate. Here's a similar metric. This is total 3ES. So that's all the altcoins that are not Bitcoin and Ethereum, and we also exclude the stablecoin. This metric has a hard time going above 1 trillion. There is a fundamental problem though with all of those metrics. So with the others dominance, with the others market cap, with the total 3ES market cap, the problem is that market caps are not a good indication of where prices are going. And prices in the end determine our performance as an investor. Let me show you what I mean. Here as a representative example, we've got WorldCoin. WorldCoin tends to peak at higher highs in its market cap over the very long term. Yes, we've got our volatility. Currently we tend to dip a little bit, but in general, over time, the market cap is going up. Now compare this with the long-term price chart. That's very different, right? It's not going up from peak to peak. The peaks are lower over time. And the reason for that is token inflation. It's the number of WLD or WorldCoin tokens that get issued over time. The supply grew by 8x over the span of a bit over 2 years. That's of course very extreme, but in general, we tend to see most altcoins expanding their supply quicker than Bitcoin or Ethereum or Solana over time. The effect is very drastic. So every week we see more than 1 billion worth of unlocks in the altcoin market. And that's just for the altcoins that are tracked here on this website, Tokenomics.ai. And so I believe this is where the market inefficiency is, where we can actually exploit that inefficiency and make money. Because it seems to be obvious that something like WorldCoin should go down in price over time. It might not go down in market cap, but it will go down in price if the supply expands this way. Yet the vast majority of traders does not agree. Have a look at this. This is the perpetual futures funding rate. So with perpetual futures, we are betting on a price. We are not buying the asset, we are betting on the price to go in either direction, to the long side, so it goes up, or to the short side, it goes down. And because the funding rate is positive most of the time, most traders on the perpetual futures market are betting on WorldCoin going up long term. They're also betting on it going up right now. Again, despite the supply expansion, despite what history has already told us. Isn't that interesting? Most perp traders got wrecked because of the token inflation. Or in other words, the token inflation is not properly priced into the funding rate. So really, the game should not necessarily be to try to find the next small altcoin that does another 10 or 100x. Here's the performance of the smaller altcoins in the last year. Most of them went down. Yes, the larger altcoins did better. So here's the performance of the top 100, but still, even they, in aggregate, went up only by 43% in the last year. While at the same time, Bitcoin went up by 71%. Ethereum went up by 69%. So even the biggest of the altcoins aren't doing great. The smaller altcoins do even worse. Have a look at this. This is Hyperliquid. This is the funding rate of WorldCoin right now. It's 11%. The longs have to pay the shorts 11% per annum to bet on rising prices. In other words, when we bet on falling prices of something like WorldCoin, we are even getting paid 11% per annum. And then we are making money on top of that because of the long-term underperformance. This is the WorldCoin price relative to Bitcoin over the long term. It went down by more than 90%. But now imagine we are flipping this around. We are betting on falling prices of highly inflating altcoins. At the same time, we bet on rising prices of Bitcoin, Ethereum or Solana. So instead of having this relative performance, we are getting this relative performance. Isn't that much more attractive than even just buying Bitcoin itself? This is a performance of 900%. Bitcoin during the same time period made a performance of 289%. So there's clearly alpha in a strategy like this. There's also volatility, like we see over here, but this is a quote-unquote buying opportunity, right? We double down on being even more long Bitcoin and even more short WorldCoin. If you, of course, believe that long-term the tokenomics will prevail, which they have over years. And again, this is just an example. Many altcoins work like this. The overall altcoin market sees massive unlocks every single week. And the reason why those unlocks exist is because the venture capitalists, they want to pull out their capital. The team wants to pull out capital. The insiders, the KOLs, etc., they want to pull out the capital. They are all dumping on the retail investor, and they are dumping at a very quick rate. That is very harmful for the altcoin market. That's why we see this performance across the board. I'm following this kind of strategy already for 4 years. In the early days, it was with borrowing and lending platforms like Aave. Nowadays, it's with perpetual futures. And this is my long-term performance here. So this is a monthly chart. It shows the last 4 years. Had I just dollar cost average into Bitcoin, I would have gotten this return here at this light gray line. But because I also bet on falling altcoins over time, I got long-term outperformance. And this is really what crypto should all be about. It's about the constant alpha. It's not about finding the 1 or 2 lucky moonshots. We want to simply compound our capital reliably over time. I have made many videos on the topic, but you don't have to watch all of those videos. You can simply stick with 3 of them. The first one is over here, using perpetual futures to bet on relative valuations. Then this one over here, risk management with relative valuation bets. Very important. People that didn't have this in place, they got wrecked in the recent crypto shakeout, which was, by the way, one of our most profitable days. Everybody has lost their money, but we had our risk management properly in place. And one part of that risk management is, of course, also setting effective stop losses. So that's video number 3. In total, all 3 of those videos combined is roughly 1 hour of content. Once you've watched that content and you've joined the community, I will share my favorite trade with you. If you do not make money with that trade after opening it and after holding it for 1 month, then I'll refund the premium membership fees to you. So really, you are not risking those 125 US dollars per month. If you do not like premium, if you do not make money with that trade that I will send you after joining, then I will just send that money back, no questions asked. A link to premium will pop up directly here on the screen. Just click on that. It will lead you to the website. If it's the very first time here, feel free to subscribe. I publish this regularly. A like would be very much appreciated as well. It helps the channel grow. See you next time on YouTube or see you in premium.